Right now, we need to go to Adrian Mowat, who is joining us, who's an emerging market expert, and right now is joining us on the phone line. Okay, here he's right there. First of all, Adrian, thank you so much for accommodating this request at the last moment. I want to understand from you what to read of the data on dollar index. It's at 106, back at 106. Last time it was at 106. So whenever it goes beyond or in that vicinity, it makes investors nervous in emerging markets, including India. Are things any different now?
So I think that there are two key drivers of the dollar strength. If we look at the situation in Japan, Japan will continue to have zero interest policy. Yes, at the long end, they may be doing a bit less intervention. So the yen continues to weaken to the 160 level. We've also had the European Central Bank starting an easing cycle, and that then compares to what's going on in the United States, where the growth numbers remain very robust. Inflation is not moderating in fast enough ways to encourage the Federal Reserve to cut rates early. And so I think there's sort of the story of the US, where you've got twice the average OECD growth in the US, a robust economy, and an interest rate differential that continues to move in favor of the US dollar, that the dollar is going to be strong. And that does cause problems for emerging markets. It causes problems for commodities as well. And I just don't see that ending anytime soon in 2024. I think one of the big fears I have actually for markets is that the US bond market is incorrectly priced. It yields 4.3 at the 10-year. That makes absolutely no sense when short-term rates are 5.5. This yield curve has been inverted for the longest time ever since the Second World War. I think you can get some history during the Great Depression where it might have been inverted for a little bit longer. So I think this dollar strength combined with the mispricing in the US bond market are the two big risks, the two big headwinds for equity markets. And I make that comment against a backdrop of very bullish markets in the US and an Indian market that had a temporary setback post the election, but is very much back on stride. But I think the summer months could prove a little bit more difficult for markets.
We've been discussing this among ourselves, among our colleagues and with strategists for some time now, that FIIs FII action in the cash or delivery base has been missing in India for a very long time. It's just the third front of domestic investors which have been helping our markets to head higher. But then strategists after strategists in the last 2 weeks have been coming on the channel and saying that the H2 would be much better because of superior growth and good macros. Even if valuations are a bit challenging, you would see FIIs flock back as far as the cash segment is concerned to India. Does it look like a strong argument, or it is just hope for the second half, which we have done before as well?
Yeah, so FIIs typically don't look at India in isolation. You know, the big pool of money is the emerging market specialist money and to some extent global money, but still thinking about the concept of developed versus emerging. And we talked earlier about a strong dollar. That doesn't tend to be a good environment for emerging markets. And for you to get an allocation towards EM against a backdrop of people anxious about anxious about China, anxious about Brazil, Mexico, and US equities are doing very well. The dynamics of that is outflows from emerging market funds. And to some extent, India suffers from that. EM funds that have been doing well have been very overweight India. And I don't think they feel comfortable in increasing that overweight. So I think this is the Indian bull market is very much a story of strong domestic fundamentals and a robust savings pool in India buying their own market.
Okay, so that's a view on India, but I just wanted to go back to the point where you were concerned about the inverted rate structure in the US. There seems to be consensus of almost 60% probability that people are putting that there's going to be a rate action in September. Do you concur with the view, or do you think that too is a bit misplaced?
I think there's a risk to that. And remember, the pattern all year has been that the futures market has been discounting too many cuts. So if you look at this from the perspective of the Federal Reserve, we've got a job market that remains extremely robust, generating 250,000 jobs a month. You've got an inflation headline that is above your target. And the delta of the reduction in inflation has been moderating. So I think there's a risk that there isn't a cut in the September meeting, and therefore there's no Fed action this side of the US presidential election. And if that's the case, then I think there's a risk. Do you recall last October that US 10-year bond yields went above 5%? I think there is a chance that you get a third quarter, early fourth quarter sell-off in bond markets, which might be also partly driven by people looking at the fiscal spending plans of both presidential candidates and the level of the fiscal deficit combined with this inverted yield curve. And I see that as a threat to equity markets, particularly a US equity market that's been driven by a narrow number of tech companies. And the price of long-term money matters to tech companies in terms of valuations.
All right, Adrian, good to have you with us. Thank you so much for running us through some of those key takeaways.
If you like this video, then like, share and subscribe to ET Now.